Hello, welcome to Money Shiksha with British, your weekly podcast where we simplify money, investing, and wealth building the Indian way. Today's episode will make mutual fund selection simple, practical, and goal-based. No jargon, no hype. Just clear steps you can apply right away. What you will get in this episode: 1. A 3-step framework to choose funds. 2. Exact fund categories for common goals. 3. A quick checklist before you buy. 4. A maintenance plan to keep you on track. Let us begin. Part 1. The 3-step framework. Step 1. Define the goal and the time horizon. Ask, when will I need this money? Less than 1 year. 1 to 3 years. 3 to 5 years. More than 5 years. Longer horizon allows more equity. Shorter horizon needs safety and liquidity. Step 2. Match risk to the horizon. Short horizon equals low risk. Medium horizon equals balanced risk. Long horizon equals growth risk. Remember, return comes from risk taken over time. Without time, do not take market risk. Step 3. Pick the right fund category, then the specific fund. Category first. Scheme name later. Do not start with brand or star rating. Start with fit. Part 2. Fund types in plain language. Debt funds. These invest in bonds and treasury bills. Use for short and medium-term goals. Safer options include overnight, liquid, ultra-short, and money market funds. For known dates, consider target maturity funds. They hold bonds to a fixed year and reduce interest rate surprises. Hybrid funds. These mix equity and debt. Good for 3 to 5 years, or for cautious investors. Conservative hybrid leans toward debt. Balanced advantage, also called dynamic asset allocation, shifts between equity and debt based on a model. Multi-asset adds a third leg such as gold. Equity funds. These own shares. Best for 5 to 10 years or more. Large cap and index funds are the core. Flexi cap or multi-cap add breadth. Mid cap and small cap add growth, but also add volatility. Use them in smaller proportions and only with 10-year money. Tax saving funds. ELSS. Equity linked savings scheme. Lock-in is 3 years. Eligible under Section 80C, treat it as a long-term equity allocation, not just a tax trick. Passive funds. Index funds and exchange-traded funds track an index. They are simple, low-cost, and reliable for core holdings. For beginners, passive is a very strong starting point. Part 3. Goal to fund mapping. Use these ready-made matches. If the words feel fast, pause and replay each goal while you make notes. Goal. Emergency fund. Always available. Time. Immediate. Choose. Overnight fund or liquid fund. Keep 3 to 6 months of expenses. Use a bank account plus a liquid fund for quick access. Goal. Bills in the next 3 to 6 months. Rent, fees, insurance premiums. Time. Less than 1 year. Choose. Overnight, liquid, or ultra-short duration fund. Do not chase extra return here. Goal. Planned spend in 6 to 24 months. Travel, laptop, minor homework. Time. Half a year to 2 years. Choose. Ultra short or money market fund. If you know the month, a target maturity fund maturing just before that date is also fine. Avoid equity. Goal. House down payment in 3 to 5 years. Time. Medium term. Choose balanced advantage, also called dynamic asset allocation, or a mix of short duration debt plus 20 to 30% large cap index. Rebalance once a year to protect the corpus. Goal. Child's education in 7 to 10 years. Time. Long term with a hard date. Choose core of large cap index and flexi cap. Add a small slice of mid cap, say up to 20%, only if you can tolerate swings. Move money step by step to short duration or target maturity in the last 3 years to lock gains. Goal. Retirement more than 10 years away. Time. Very long term. Choose 2 fund core. 1. Nifty 50 or Sensex Index Fund. 2. Short duration or corporate bond fund for stability. Add small slices of mid-cap or small cap only if you understand volatility. Increase equity through SIP, shift gradually to safer debt 5 to 7 years before retirement. Goal. Retirement income after you stop working. Time. Ongoing. Choose a bucket plan. Bucket 1. 2 years of expenses in liquid or ultra-short funds. Bucket 2. 3 to 5 years in short duration or target maturity funds. Bucket 3. The rest in large cap index and flexi cap for growth. Withdraw monthly using SWP systematic withdrawal plan. Refill bucket 1 from bucket 2 and 3 during good markets. Goal. Parking a lump sum while you phase into equity. Time. 3 to 12 months. Choose liquid or ultra-short fund plus an STP systematic transfer plan. Move money in steps into a chosen index fund. Part 4. How to pick a specific scheme inside a category. Use this 6-point checklist. Keep it simple. 1. Fit to category and benchmark. Does the fund actually behave like its label? A large cap fund should behave like a large cap index. A balanced advantage fund should truly shift exposure through cycles. 2. Costs. Lower expense ratio is better, especially for index funds. For active funds, pay only if the process is clear and consistent. 3. Portfolio quality and risk. For debt funds, check credit quality. Prefer high-quality portfolios for goals. For equity funds, look for diversification. Avoid funds that are secretly concentrated or thematic when you want a core holding. 4. Process over personality. Choose funds with a defined process, not star chasing. Fund manager changes will happen. A consistent house process survives changes. 5. Size and liquidity. AUM, assets under management. Too tiny can be fragile. Too huge can be clumsy in small cap categories. Middle is fine. For ETF, check trading volumes. If volumes are thin, prefer an index mutual fund instead. 6. Practical frictions. Exit load. Minimum holding. Tracking error for index funds. Ease of SIP and STP, make sure it fits how you will actually invest. Part 5. How much equity and how much debt? A quick thumb rule you can adapt. Less than 3 years. 0 equity. Pure debt. 3 to 5 years. Up to 30% equity via balanced advantage. 5 to 7 years. 40 to 60% equity, mainly large cap and flexi cap. 7 to 10 years. 60 to 70% equity. Small mid cap only as a small satellite. 10 years plus. 70 to 80% equity if you can sleep well at night. If not, reduce equity until you can. Remember, these are starting points. Your comfort matters more than any rule. Part 6. SIP, STP, and SWP in 1 minute. SIP, Systematic Investment Plan. Use for building long-term goals. Set it. Forget it. Review once a year. STP, Systematic Transfer Plan. Use when you have a lump sum but want to enter equity slowly. Park in a liquid or ultra-short fund. Transfer monthly into your chosen equity index. SWP, Systematic Withdrawal Plan. Use in retirement to create a monthly income from your corpus. Pair with the bucket plan. Part 7. What to avoid. Avoid using small cap or thematic funds for short or medium goals. Avoid chasing past 1 year returns. Avoid new fund offers, also called NFO, unless you have a very specific reason. Avoid changing funds every quarter. Turnover kills returns. Part 8. Taxes and paperwork in brief. Tax rules change. Learn the basics before you invest and confirm current rules. Debt and equity funds can have different holding periods and rates. Dividends are not free money. They are taxed as income. Use direct plan if you are a do-it-yourself investor and you know what you are doing. If you value advice and hand-holding, pay a fee-only advisor and still use direct plan. Keep KYC updated. Keep nominee details updated. Keep statements in one folder. Part 9. Maintenance plan. Once a year, do 3 things. 1. Rebalance to your chosen equity and debt split. 2. Move near-term goal money from equity to safer debt. Do this 3 years before the goal date. 3. Increase SIP by 5 to 10% if income has grown. A simple example to tie it all together. Example. You have 3 goals. Goal A, emergency fund of 6 months. You put it in a mix of bank savings and a liquid fund. Goal B, house down payment in 4 years. You choose a balanced advantage fund at 50% and a short duration fund at 50%. Rebalance yearly. Goal C, retirement in 20 years. You choose a Nifty or Sensex index fund as the core. You add a flexi cap fund. You add a small mid cap fund up to 15%. You run SIP every 5th of the month. 5 years before retirement, you start shifting 10% per year from equity to short duration debt. That is it. Clear, calm, and automated. Fast recap. 3-step framework. Define the horizon. Match the risk. Pick the category, then the scheme. Ready matches by goal. Emergency and near term. Overnight, liquid, ultra short. 2 to 3 years. Short duration or conservative hybrid. 3 to 5 years. Balanced advantage with some debt. 7 to 10 years. Large cap index and flexi cap. 10 years plus. Equity core with measured mid cap or small cap. Tax saving. ELSS, lump sum to equity. Liquid fund plus STP, retirement income. Bucket plan plus SWP, checklist. Fit, cost, quality, process, size, frictions. Maintenance. Rebalance yearly. They risk near goals. Step up SIP. Final note. The right fund is the one that fits your goal, your time, and your sleep. Decide once. Automate the decision. Review on a schedule, not on headlines. Thank you for listening. This episode is for education. It is not personal financial advice. If it helped you, share it with one friend who is choosing funds right now. See you in the next episode.